Most people who start investing dream about retiring early someday. And history shows us that this is entirely possible as long as you have the patience and can consistently build your portfolio without letting emotions take over your decisions. Over the years, there have been many hyped stocks. How many times have we heard about the new Apple or the next Tesla? Let me remind you that if you had invested in Apple at the start of 2023, you would have seen a 70% profit, excluding dividends. And don't even get me started on the 5-year chart. I'm not saying you should buy Apple today. What I'm saying is that there are stocks with a significant advantage in their industry. We call this a moat. And a company's moat refers to its ability to maintain the competitive advantages that helps it fend off competition and stay profitable into the future. When building your retirement portfolio, you need to include a few companies with a strong moat to achieve substantial returns. I'm not just talking about the magnificent 7 stocks. We all know that these companies change over time, and that's okay. As Warren Buffett famously said, we don't need to hit the ball out of the park every time. It's about getting steady returns and sleeping well at night, knowing that the businesses in your portfolio are strong. And with that being said, let me explain what I look for when selecting stocks for retirement. First and foremost, the company needs to have a strong moat in its business. Second, we prefer a high return on capital. Most of the time, companies with a strong moat tend to have a higher return on capital anyways. We also aim for companies that can grow their margins over time, again indicating a strong competitive advantage. We also want that these stocks to be fairly valued. Many stocks meet the first criteria, but are priced at a heavy premium. We want to buy these stocks today, when they are fairly valued. This may still mean you paying a small premium, but not overpaying. Lastly, we want these stocks to pay a steady dividend. This is a small bonus for me, as I know that dividend-paying companies aren't always better than non-paying dividend ones. In fact, many companies that don't pay dividends still outperform those that do. That's why I see the dividend as a bonus in this case. Let's kick things off with the company that has one of the strongest moats in the world, Visa. It also happens to be my favorite company. And Visa is the market leader in their industry, and there are many different pie charts all indicating slightly different numbers. So the truth is somewhere in the middle. Visa is one of the largest companies in the world, with a market cap of 565 billion. Their PE ratio is at 29, indicating you pay a small premium for this company. And in my opinion, this is justified. Revenue is around 35 billion, and in this graph we see that revenue went up really steady and consistent over the years. During the lockdown periods there was a small decrease, but every year they hit a new all-time high. Return on capital is reported at 24%, which is an insane high number. It is also higher versus the 5-year average, which is also a really good sign. Looking at the margins, we see that both the operating margin and net margin are increasing really steady and consistent over time. This is looking really good, and to me this is what I call a moat. They are able to grow their revenue in double digits every year, and the margins are increasing as well. And Visa is known for paying a small dividend. 0.75% is of course not too exciting. But take a look at their payout ratio and growth stats. This screams that Visa is a great dividend growth stock. To me, this looks really good. For the price target, I'm using the Everything Money software. I'm filling in 3 assumptions and we get 3 price targets. We have a low price target of 182, a mid price target of 233, and a high price target of nearly $300. And to me, the high price target is the most justified here. So we only got a small window, but to me Visa is one of the best companies out there. And as of lately the stock has increased a little bit, so it would be perfect if it goes down a little bit. For now, I keep adding more shares of Visa throughout the year. Second on the list we have Alphabet, ticker symbol Google, another company that has a really strong moat in their industry, where the market share is around 90%. It almost doesn't get better than that. Alphabet is a 2 trillion market cap company, placing them in the top 5 largest companies in the world. And for a company with such a strong moat, the P/E ratio is relatively low at 22. Revenue is at 328 billion, and in this graph, we see that it has been growing really steady and consistent over the years. There was a little bit of a slowdown, but most recently it has been increasing at a high pace again. Return on invested capital is reported at nearly 16%, which is a great number. It is also higher versus the 5-year average, which is also a really good sign. Looking at the margins, we see something really interesting. From around 2010 up until 2018, the margins were decreasing quite a lot, and from there they started to increase again. However, there was a big decrease again in 2022, of which it's recovered pretty quickly. For now, things are looking really good. Alphabet just started to pay a small dividend at 0.5% dividend yield. Payout ratio is sitting at only 3%, so there's quite some room to increase here. Overall, it looks pretty good to me. And here comes the great part, the price targets. And again, I'm using the Everything Money software to get the 3 price targets. We have a low target of $98 to $136, a mid-price target of $135 to $181, and a high price target is in the range of $184 to $242. To me, the mid to high price target is the most justified here, indicating Alphabet is massively undervalued according to these numbers. It has to be said that I used to own Alphabet around the stock split, and I sold with a small profit there. And to be honest, I really regret that I sold too quickly. And at some time, that's one of the great things about investing. It's a learning process where you are going to make mistakes. And that's okay, since over time you're able to learn more and make better choices. So that's why I decided to put Alphabet on my buy list again. And I can't wait to add it to my portfolio. Moving on to the third company, Starbucks. Again, one of my favorite companies out there that have a really strong moat. And there's no denying that it has been an interesting few weeks for Starbucks with the new CEO announcement and interesting earnings. Starbucks has been rapidly increasing their stores over the years and outperformed the competition, showing investors that they are the best coffee chain company in the world and they have a strong moat in their industry. Starbucks is a 104 billion market cap company with PE ratio around 25, indicating you pay a small premium for the stock. Revenue is at 36 billion, and in this graph we see that revenue has been increasing really steady and consistent over the years. However, most recently revenue is coming down a little bit, which is of course something to keep your eye on. And now the good part about this company. The return on invested capital is sitting at nearly 50%, which is insanely high of course. It is also higher versus the 5-year average, which is something that I really like. Their margins have been a roller coaster, but in the long run it's going up. Starbucks said in the earnings presentations that they expect margins to start increasing from this point on. So let's see where things are heading here. Starbucks pays the highest dividend yield of all companies in this list at a juicy 2.5%. Payout ratio is coming in at 64%, which is a little bit on the higher side. But I expect that this number will go down based on the recent earnings report. Growth rates also look really good and they have a solid track record. And here comes the interesting part, the price targets. Again, I'm using the Everything Money software to get the 3 price targets. We have a low target of $59, a mid-price target of $80, and a high price target of $108. And to me, the high price target is the most justified here, indicating Starbucks is still undervalued according to these numbers. And not too long ago, I decided to heavily increase my position in Starbucks when it was trading around $75. And I'm really glad I did. I was able to DCA a lot during this time, and it has been paying off. For now, I will slowly add more shares of Starbucks, since it is already the biggest stock in my portfolio. Fourth on the list we have Nike, and this may come as a surprise to some people, but hear me out. Nike has shown us over the years that they are able to outperform the competition by large numbers. And it also has to be said that ever since their late 2021 peak of $180, the stock has come all the way down to $80. And not too long ago, it was sitting around $70. And Nike is a 122 billion market cap company, with a PE ratio at 21.5. Again, for a company with a moat, this is not too bad. Revenue is at 51 billion, and in this graph we see that revenue has been increasing really steady and consistent. However, Nike is struggling right now to grow their revenue for a couple of quarters in a row, which didn't really happen in the past decade, if we exclude the lockdown periods, of course. Looking at the return on capital, I'm really getting excited. The current number is reported at nearly 21%, and it is also slightly higher versus the 5-year average, both looking really good to me. Margins are a bit of a roller coaster, but at least the trend is upwards long term, but also in most recently. To me, this looks pretty decent. Nike pays a decent 1.8% dividend yield, and payout ratio is looking really good at only 37%. The growth numbers also look pretty good at nearly 11% and 11 consecutive years of dividend increases. For the price target, I'm using the Everything Money software again, where I fill in the three assumptions. We have a low target of $45, a mid-price target of $66, and a high price target of $95. To me, the high price target is the most justified here, indicating Nike could be undervalued according to these numbers. For now, I'm waiting a bit, hoping that the stock price will come down slightly. With that, I'm giving myself a bigger margin of safety here. Nike is a company that will do great in the long term, but it is currently struggling a bit. Because of that, I want to buy this stock at a slightly lower price. Last one on the list is actually a tricky one, since it's not a singular stock, but it is the S&P 500 ETF. And I know this may come as a surprise, but again, hear me out. There are two things that I really like about the S&P 500. The first one being that about 90% of the investors are not able to beat the S&P 500 in the long term. And I'm not talking about 2 to 5 years, I mean 10 to 20 years at least. So for many people, investing in the S&P 500 is the obvious choice here. Yet, not everyone does it. So if you want to beat 90% of the people in the market and don't worry overnight about your investments, take the S&P 500. This index has an average of about 10% annual return in the long run, which is insanely hard to match. The second reason is that the S&P 500 pays a decent dividend of about 1 to 2% depending on which ETF you buy. Of course, there are also ETFs that pay no dividend and reinvest it directly, but you get the point. The S&P 500 has a great diversification obviously, which could also be a reason to add it to your portfolio. And I know that Apple and Microsoft and a few others make up for a large amount of the S&P 500, but that's okay. Over time, this will change, and if not, then I'm glad that I'm catching a few of these big waves. And there are always risks when you start investing in a company or an ETF. But when the entire S&P 500 closes or goes to zero, you probably have bigger worries than your portfolio. So that's also something to keep in mind. Looking at the past few years, we see that the S&P 500 was hitting that 20% mark a lot of times on an annual basis. In total, the S&P 500 returned 93% including dividends in the past 5 years. Looking at the valuation, it's a little bit harder to come up with the correct one. That's because there are many different companies in there, and you can't compare Apple, the biggest shareholder of the S&P 500, to News Corporation, the smallest stakeholder in the S&P 500, and that's okay. But let's take the 10-year PE ratio. This is sitting at 35, suggesting that the market is overvalued. And that's the tricky part of investing. A stock is worth what people want to pay for it, because in the end it's a bid and ask system, as sold as it gets. And if we learn one thing about the S&P 500 historically, it is that it always will find its way up. After the dot-com crisis, the financial crisis, and even after COVID, there was a new all-time high rather quickly. And please don't get me wrong here. I'm not saying you should buy the S&P 500 blindly. All I'm saying is that if you want to get steady and decent returns, the S&P 500 is probably the closest it gets. And a lot of brokers offer no transaction cost on a certain S&P 500 ETF, which makes it even more attractive to buy them. All of this led me to conclude that the S&P 500 should be the biggest investment within my portfolio. I'm aiming for at least 30% share, where singular stocks have a maximum of 10%. And with that being said, we are coming to an end of this video. Make sure to check out my full portfolio breakdown video to understand more about my decisions and of course about the dividends that I receive. But remember to always do your own research and never fully trust on what I or other YouTubers say about a stock. I'm not a financial advisor and this content is just for entertaining purposes only. I hope you liked this video and I did bring some insights of the company to you. I would really appreciate a thumbs up and make sure to subscribe to get notified when I'm posting a new video. Thanks for watching and I will see you in my next video.